mute your. Well, welcome everyone. Just going to give it a minute for just make sure everybody else can get in for this pension affinity update. Um, I'm Robbie Sandless, co-chair of the Pension Affinity Group and past president of Maryland GFOA, and with me is the other half of the co-chair and the current president of the GFOA, Rafael Yehile. See, now I've been working on the last name pronunciation, Rafael.
No, you got it right.
Yeah, well, so um, all right. Let's see. I think there's a couple people there in the waiting. So, all right. So with that, let me just start off. I'm going to start off with the introduction. I think we got a really interesting session here about some interesting um, both just some interesting investment opportunities, but I think also an opportunity to kind of talk about some of the global markets and particularly international trade and tariffs have certainly been in the news this week with the Supreme Court ruling and the like. And so I think this all ties up into a lot of these kind of maritime investment opportunities. All part of those alternative sleeves that you may have in your pension funds. And with that, I'd like to pull this up. I would like to welcome Bryan Schneider as the Senior Managing Director and Product Specialist at EnTrust Global on the Blue Oceans team. He joined them as a Senior Vice President in January of 2010 with 10 years of prior experience in the financial services industry. So before joining the firm, Mr. Schneider was a Senior Consultant at NEPC, where he was responsible for overseeing more than $20 billion of client investments. Mr. Schneider holds a BA in mathematics from St. Anselm College, and is a member of the Boston Security Analyst Society and the CFA Institute, and holds the Chartered Financial Analyst designation. And so with that, I'd like to turn it over to Bryan to discuss some of the private credit opportunities in maritime.
Terrific, Robbie. Thank you for that kind introduction. I was speaking at a California public fund. One of our clients had a client review update, and they had some other managers who were providing education on what it is that they do. And I thought it was interesting. One of them was a aviation focused manager. One of them was a rail focused manager. The aviation manager came dressed as a pilot. The rail focused manager was dressed as a train conductor with a train whistle, and we didn't have anything. And I think that's part of the story here, is that there's really not a lot of gimmicks with this strategy. We're talking about shipping. We're talking about global shipping. And when I get through the story, I think hopefully what you'll understand is that there's a clear opportunity set. It's relatively straightforward what we do, and it's easy to understand and focus on an industry that is global is vital to the global economy. There's high barriers to entry, though, which makes it difficult for new participants to come in, which keeps the competition low. When we talk about some of the issues impacting the credit markets right now, that's an area of focus for us. And then the other thing is that this is something where there is really a critical and dire need of capital for a lot of the shipping companies of the world. And because there's this scarce capital that we're providing, it really gives the lenders an edge in terms of the negotiations, which means we can extract favorable terms that not only helps on the return side, but also on that risk control and downside. And so with that, what we have here, I'm going to spend the next few minutes talking about the global shipping industry, talk about why we think this is a compelling investment opportunity, introduce the markets, introduce the shipping industry, review some of the recent headlines that we're all well aware of and how it's impacting the shipping markets, and then explain how this can potentially be a benefit to you, the allocators. And we've compiled now a 9-year track record. And what you can see is that the numbers are going to be attractive in their own right in terms of absolute returns, but it comes as a strategy with a high cash flow generation, very strong downside protection, all delivered in an uncorrelated manner. So additive to a lot of institutional portfolios. And so with us, just a brief background on EnTrust before I get into the meat of the presentation. We are a $16.5 billion alternatives manager headquartered out of New York City, 130 employees globally, 550 institutional investors. I work with our Blue Ocean Maritime private credit business. That's about a $6 billion private credit business focused exclusively on the maritime industry. For us, as I mentioned, it's mainly an institutional product, and we show here just for your benefit, roughly 40%, just under 40% are pension funds, no different than yourselves, a lot of U.S. pension funds and as well as international. Getting now into the maritime industry. So everything we do is focused on the maritime industry. Said differently, shipping. We're talking about shipping here, and I want to provide some context on what this industry is and frame it in terms of its importance on the global scale. It's about a $2.1 trillion industry when you add up the value of the roughly 123 commercial vessels that are on the water globally today. It's been around for hundreds of years. It is critically important to supply chains, to global trade, and economic growth. It is the most fuel efficient and cost effective way of moving mass quantities of goods on a global basis. And it's absolutely vital when you talk about the need for energy and food security globally. We kind of give some pictures here of some of the things we're talking about, some of the things you would see if you look out in the ports of Maryland. Of course, you would see some of the container ships that are out there, but it's so much more. We'll get into just how big and vast this industry is. But a lot of the things and what I think is comforting to a lot of trustees is these are assets you can touch. You can see exactly what it is that you're financing and understand their world, the role that they're playing in the global economy. The other thing that's worth noting here, when you talk about global trade, is just how important maritime assets are in that equation. We show here on the left that this 2.1 trillion industry of shipping, it's responsible for 86% of all trade globally. Likely something around your house or your office was brought to the States on ships, right? So it's not only shipping, it's everything on a global basis. It's really a global business. And we get into some of the comments on tariffs, you'll see that some of it is really not impactful because it's such a global business that a lot of the ships don't even touch the U.S. ports. So keep that in mind, though. It's so big and so important. Limited displacement risk right now. You're talking about assets where there's limited risk of technological change that's going to disrupt this industry. That's a big headline in the world today. How is the internet, how is AI going to transform businesses, going to transform job functions? Here, there is limited risk of anything like that happening, which for us as lenders is an important distinction on how we gain comfort in the assets that we are financing. So big and important on the global economy is what we're looking at, but it's vast. This industry is comprised of upwards of 10 different underlying sectors of shipping. We provide here on the screen a few of these areas. Let me spend just a few minutes explaining it from an educational perspective. There are areas that we call commodity shipping. These are things like container ships. Container ships are carrying boxes of finished goods, everything from your t-shirts, your sneakers, your jeans, could be electronics, TVs, workout equipment, patio furniture, things like that, largely produced in low manufacturing areas in Asia, put into these boxes. These boxes are put onto ships 8 to 10 to 12 to 15,000 boxes at a time, and the goods are transported across the global economy. You have your dry bulk area, which I equate to effectively floating dump trucks. These are vessels that are carrying things like iron ore, coal, grain, and wheat across the globe. And then you have your tanker assets, which are carrying energy such as oil and natural gas. That accounts for the commodity shipping, which is a big part of shipping, and I would say the area most people tend to be more familiar with. But shipping is so much more than that. There are other areas out there, and part of our core opportunity set to take advantage of. You have the offshore construction and energy infrastructure. So think about offshore energy production, whether it's wind farms or oil fields that are offshore, not only the actual energy producing assets, but how are these assets built and maintained and provided with in terms of labor and supply. There's a whole ecosystem of vessels that are responsible for the production, maintenance, and ongoing supply of those assets. You have passenger and car carriers. So think of things like ferries and cruises and car carriers are whole opportunities that are part of the maritime universe for us between offshore energy and between the cruise industry. We've seen some really interesting deals of late. In ports and maritime equipment, you have thousands of ports across the globe, and you have a need for modernization of a lot of these areas, especially in the emerging economies. So anything that really touches the water there related to that is a part of this whole $2.1 trillion industry of maritime finance. The other thing that's worth noting now is this industry is vast. There's 4,000 companies across shipping. But ultimately, though, when you're a lender, the way you get comfortable is how these actual assets produce their cash flow. And that's what we show at the bottom here are examples of the actual end users of these assets tend to be some of the biggest companies of the world, high quality credit rating companies that are simply these big companies. They're not fully integrated from their supply chains and logistic chains. So they need to use the resources of these 4,000 shipping companies globally. So for example, we may finance a company that owns tanker assets, but the actual end user of those tanker assets would be like an Exxon, Saudi Aramco, a Shell of the world. So it's these bigger companies that are the actual end users of these underlying assets. So big industry, global, very vast is what we're looking at. And I mentioned these underlying 10 plus or so different subsectors of shipping. I bring that up because one of the big benefits of the shipping markets and a potential allocation to maritime finance is the uncorrelated aspect of how this would fit into your portfolio. And what we demonstrate here and have the data to support it is that not only is shipping generally uncorrelated with other major asset classes, but shipping industries and subsectors tend to be uncorrelated relative to one another. So for a skilled maritime investor, having that ability to understand the entire global maritime market, all of the subsectors, and when it's important to move across different sectors. Because one of the things that's really interesting here with shipping is that you understand what drives the cash flow, the earnings, and the ultimate value of these vessels. And there are equations on the supply side and on the demand side that investors and allocators will understand drive those future cash flows. And for us, we understand that shipping is inherently a cyclical industry, but each one of these underlying segments has their own cycle. And we spend a great deal of time assessing where each one of these underlying subsegments is in the respective cycle. And we know at any given time how many vessels of a particular type are on the water, what their average age is, what their speed is, what the routes and cargo that they're taking are, and importantly, how many vessels are in the shipyards globally that are being built that are going to come to market. And so when you hear about impacts to the shipping market, and we'll get now into some of the global geopolitical developments there, one of the things to note is supply side economics. How many vessels are on the water today? How long are they taking to get from point A to point B? And how many vessels are going to be coming to the water in a few years that are being built. Those things are completely unique to shipping. They inform your cash flows, and they are an important part of the equation that, again, drive that uncorrelated benefit to what it is that we do in the maritime industry. And so this maritime industry, shipping, right, it's been around for hundreds of years. Headlines impacting the industry are not new. We show here, just going back the last 35 years or so, some of the major headlines we've all lived through, dating back to the Gulf War in the early 90s, the Asia financial crisis, late 90s, and of course 9/11 into the global financial crisis of 2008, how have all impacted shipping or global markets in different ways. More recently, when you get into the pandemic, when you get into the involvement of the war between Russia and Ukraine, the Middle East escalation, and then now the trade wars, all of those things have been headlines that have in some way or another impacted shipping markets, and yet shipping continues on. It shows and demonstrates its resilience, its importance on the global scale. And I think when you walk through examples of what exactly happens here, it's easy to understand just how these assets are able to navigate the waters, if you will. Starting with the pandemic, something on a more recent basis that we all lived through, what I would say broadly with a lot of these different geopolitical headlines is that they tend to impact subsegments of the shipping market differently. Some get a positive aspect to these things, some are hit more with headwinds. So think about the pandemic, for example, going back a few years. During that time, a lot of us were stuck at home. People globally were stuck at home. We were sitting in front of our computers. We were ordering stuff. We were ordering more sweatpants. We were ordering workout gear. We were ordering new televisions or computers, patio furniture. A lot of that stuff, again, is manufactured in low manufacturing bases across Asia. It's put on the container ships and then it's sent across here to the United States. So demand increased for these goods. At the same time, you had COVID-related port disruptions where they could not offload the vessels. There's famous photos out in the ports of LA where you had vessels that were 40, 50 deep out in the water. It took 45 days or so for them to get offloaded. Normally, you're looking at a period of a couple of days. And so when you have this disruption, somewhat counterintuitively, what tends to happen in shipping markets is the vessels are at sea longer. When they're at sea longer, there's less vessels available to take the demand of new cargo. Because of that, there's less vessels remaining for that new demand, which drives the pricing higher. So this is an example where during the COVID period, what you saw in the container ship sector was pricing went up significantly. This is an area where pricing went materially higher. And let's talk about how that impacts the world. Well, if you are a ship owner, you are now making significantly more money in the container ship sector. These asset owners made more in 1 year during the pandemic than they did in the previous 10 years combined. A lot of them took that newfound cash flow and reinvested it in the market by buying new ships. Unlike some of the things we buy on Amazon, though, this takes years. It can take 3 to 5 to 7 years for these new assets to be delivered. And so right now in the container ship market, assets remain elevated, and there's a very high new order book that is a function of a lot of that cash flow that came from the pandemic. So even though the pandemic was now 5, 6 years ago, at this point, there's still ramifications impacting the shipping market that I'll talk more about momentarily. Conversely, though, what you see in the tanker market was a situation where global energy consumption declined significantly as people were not leaving their home, as flights weren't happening, as people weren't going on vacations or traveling for work. And so with that, there was a headwind to the tanker market. That is an area where, because of that, earnings dried up, cash flow dried up, and that became more of a cyclical low. And so one of the things that you saw in that market that started to turn was now this next development when Russia in 2022 invaded Ukraine. Now you have this another geopolitical event that is in the headlines of the shipping world. Because when you think about Western Europe and their energy needs, a lot of their source of energy used to come from the pipelines of Russia. But following that invasion, there was now a race for energy independence on behalf of a lot of Western nations. And a big variable to solve for that was the shipping markets. Now energy and oil is being imported into the continent. It's coming from the Gulf, it's coming from South America, it's coming from the Middle East, and it's coming from Western Africa. A lot of that is coming through on the shipping market. So now you have a need for energy, and it's being solved by this global vital asset, which is the energy markets and the tanker markets. So while the tanker markets had headwinds during the early part of the pandemic, you saw it start to recover and really become a force for benefit on consumers globally during that period. And now that's extended to where we are with the Middle East crisis. When you saw the Houthi rebels began to attack commercial ships that were traversing the Red Sea looking to use the Suez Canal. In this dynamic, when you think about a map of the world, the shortcut to get from Asia to Europe and to the East Coast of the United States, including Baltimore, is going through the Suez Canal, through Egypt, up through the Red Sea, into the Mediterranean Sea. However, with that threat from the commercial vessel attacks by the Houthi rebels, here is ultimately what happened. Traffic utilizing that area declined significantly. This is one of the biggest takeaways, I think, from this presentation. When you think about shipping, and when you think about what we do, which is financing these hard asset collateral vessels, these vessels can be thought of as floating real estate. It's floating infrastructure. But the difference between a building and a ship is that a ship is global and it's mobile. So when you see periods of risk like this in the market where there's threats of attacks coming through the Red Sea, the reality is what happened? Most commercial vessels decided to take the longer route around the southern tip of Africa to avoid that trouble. Remember what I said about the pandemic with the container ships when they're at sea longer? It's a similar dynamic here, where because of this threat, traffic is taking the longer route around, which means the vessels are at sea longer, which is driving up pricing. So not all vessel types utilize the Red Sea and the Suez Canal in the same manner, but that's something that has been inflating pricing for certain of the sectors, namely product tankers and on your container ship sides. Whereas you look at a cruise ship, for example, cruise ships are not going through the Suez Canal, so they've been less immune. And then now you get into the trade war, and what's going on here? You have this uncertainty following Economic Liberation Day announcements about the tariffs. We are looking at our portfolio, trying to figure out what our exposure is, what the impact is. And back to the earlier comments on this being a global business, the interesting thing here, when we looked at our existing portfolio, 85% of the assets we finance were not impacted at all. They don't even touch the US ports because it is such a global business. Of the balance that did, they had guaranteed visibility into the cash flows because they work with those investment grade companies that are out there to guarantee the use of those assets over time. So they guarantee daily cash flow rates over a period of months and quarters and years that provides that downside protection. And so you've had a lot of these headlines that have impacted the market. They haven't impacted all of the assets or subsegments in the same way. Some of them have been positive. Some of them have been more headwinds. The important thing for financiers in this space is the ability to recognize these things, figure out what is short term, what is more secular and longer term in nature, and be able to pivot to where the opportunities are across shipping at the right time, assessing how not only these things are impacting it, but how those inputs into your models on the supply side also have that dynamic. Through all of that, whether it's COVID, whether it's the Ukraine, whether it is the Middle East, whether it is the tariff uncertainty, what we show here again is resiliency. This is an industry that accounts for 86% of all trade globally. Trade continues to grow. GDP growth globally continues to expand. And even with some of those headwinds, if you look at the right-hand side of this chart, what you've seen is growth in shipping globally over the last several years. Certainly, if you extrapolate that over longer term, you've seen about a 3% growth per annum over the last 20 years. You've seen a 16% growth in the shipping markets just over the last 10 years. And then even now over these last couple of years, even with that elevated uncertainty and headlines, still growth in the shipping markets. This is an industry that is vital to global trade, and it needs money, and it is irreplaceable and indispensable in that aspect. And those are things that we think is very important as a base for why we are looking to become lenders in this business. With that as a background on kind of what the shipping industry is, I think the next area to understand is exactly what is the opportunity then? If you have this big industry, why are we explaining to you that there's a potential opportunity for you as an allocator? Why do we have a $6 billion business in this industry? And why do we get excited talking about shipping? And here, the next few pages will kind of provide some insight into that. And here's where I think it gets even more interesting. Back to competition. When you look at other areas of the credit markets, one of the things that's become evident over the past number of months and quarters is that there's increasing dollars chasing fewer deals. When you have increasing dollars chasing fewer deals, that leads to potentially lower returns, and it potentially leads to what's called covenant-light transactions, which tend to be more risky. We're not seeing that in the shipping markets because there is a lack of competition compared to other areas, and I'll explain what I mean by that more in a moment. One of the things to note, though, is that there is no structured market in the shipping markets. Most of the funding that happens in the shipping markets historically was done by banks. And what we show here on the left-hand side is just how the overall impact of bank financing has changed over the last, call it 15 to 20 years. And it really goes back to the global financial crisis. Before the global financial crisis, most of the financing needs of the shipping market were completed by banks on the global scale, but specifically European banks were some of the biggest players here. We show the numbers in the orange bar charts, $450 billion in 2010 down to 290 for the global banks, and European banks, even more of a stark reduction in lending, which they're down about 60% in terms of the capital that they've provided. The reason why is that following the 2008 financial crisis, increasing regulation made it more difficult for banks to hold a lot of these loans on their balance sheet. That was especially true across what we've seen in Europe. And that's what's leading to this reduction in the availability of traditional credit to the shipping industry. So unlike some other areas in the credit market that have been around for 30 plus, 40 plus years that are dealing with a lot of the private equity sponsors, here it's a different scenario where the opportunity for alternative lenders really only started in scale following the 2008 financial crisis. And with this trend of the declining availability of traditional credit, that is what had us start our business. We started our business in 2015 on the back of this thesis that not only do you have a dynamic where the industry has less capital available, but it continues to grow. And it continues to grow, and it's a capital intensive industry. Shipping needs $80 to $90 billion a year estimated in order to function. That's for these 4,000 ship owning companies globally to buy new ships or buy used ships or refinance their loans. They used to go to the banks. The banks aren't as available anymore. And that is what this whole opportunity is that we think makes for a really compelling business opportunity. At the same time, one other important aspect worth noting is that of these 4,000 companies, it's a very fragmented industry. And when I say fragmented industry, there's 4,000 shipping companies globally. Of those, we show 4%, just under 200 of them are considered large. Those companies are very large. They're very well banked. That is not largely who we are doing our business with, but by number, the balance, or nearly 95% of shipping companies globally, are considered small to medium size. These are the companies, they own anywhere from 6 to 10, 20, 30 vessels as a part of their fleet. They tend to be always buying and selling vessels or refinancing their existing loans. Most loans in the maritime space last 5 years, and the assets have 25-year useful life. So you have a lot of financing needs that are going on in here. And so if they can't go to the banks as regularly anymore, and the IPO markets aren't as receptive, where can they go? And that is exactly the thesis that we have behind our business. And so for us, we aim to be that choice of financing partner for them. We have a $6 billion business. We've done over 100 transactions now. And I think this chart is pretty interesting that talks about the stability of our business model in the face of volatility, not only of markets, but of interest rates. So let me explain what I show here. We have a historical look at the evolution of the interest rate of the loans that we have across our platform dating back to 2019, we show here in the blue bar chart. And what I think you'll see is a pretty steady level of interest rates that we're able to extract from our borrowers. A typical loan for us, we are senior. We're the only debt providers in these customized SPVs. Primarily sourced transactions, we're charging 11 to 14% on average. We get 1.5 to 2 points of upfront fees, usually some level of back-end economics. And these are situations where we require over what is usually a 4 to 5 year loan tenor payback of the loan. And so you're getting between the cash flow coming back of the interest rate, the fees, and the principal that's getting paid back in the neighborhood of 15 to 20% of your cash is being returned every year. Very high cash generative strategy. But for us, the stability of the interest rates we think is one thing that's worth noting. Most of what we do is fixed interest rates. Upwards of 90% of our portfolio shows fixed interest rates. And despite what you've seen with declining interest rates over the past year, and even when interest rates were at their floor during the height of the pandemic, we were still able to extract these low double-digit rates. That is less a function of where interest rates are, in our view, more of a function of the scarcity of the capital that we are able to provide and the manner in which we were able to provide it. So continuing able to deliver on our value-added proposition to our borrowers is one of the things that separates us in this market. And this, I think, is another important point. If this is such a big opportunity set, and we've been able to generate the returns that I'm going to show you in a moment, how come we're not seeing more competition? How come other folks in the credit markets aren't focusing more on maritime finance? And the reality is that there are high barriers to entry for alternative lenders in this space. There's two important factors here. Number one, it's exclusively focused on shipping. As I mentioned, shipping is a complex industry comprised of over 10 different underlying sectors. So you need to really understand the nuanced drivers of a lot of those underlying factors. So a lot of people don't have that specialized shipping knowledge, number one. And number two, with the fragmented industry of these 4,000 companies that are global in nature, do you have the direct relationships to be able to source the transactions? And so those two things, the industry knowledge and the network out there, are barriers to entry for other providers out there potentially looking to come in. And so for us, we benefit from another two different ways, which is in recognition of this trend of the pullback of traditional financing. We created this business and we're one of the first movers here. So we started this in 2015. We now have deployed over $6 billion, have done over 100 transactions. And so we have a first mover advantage focusing on alternative lending to the shipping industry. And then we are one of the players of scale in terms of alternative lenders. Those two things have distinct benefits. We now have this track record we can point to. We have a team of 28 dedicated folks focused exclusively on this maritime finance opportunity. And we can say, listen, here's our track record. We've done over 100 deals. We've done over $6 billion of business. We know the shipping markets. We can provide what you need, Mr. or Mrs. Ship owning borrower, in a timely manner. With high confidence, it can be completed. With flexibility to understand what it is that they need. And we have the scale because we've raised the money in order to meet their needs. There are few places these folks can come to and get all of those done in one spot, including our flexibility across the capital structure. And that is sort of that reputational advantage that we think we fit within this equation, where frankly, anyone can take advantage of this opportunity, but we think there's reasons why they are unable to compete with us the way that we've been able to build out our business. And from that, there are distinct advantages that we can do. As I mentioned, it is charge the higher returns, which is the higher rates, and have higher risk controls that come in the form of strong covenants that I'll hit on in a moment. So it's those two things that are important that really drive that return profile on the upside and the downside protection. Within that, if you think about, all right, so you have this team, what exactly does that mean? Well, we have a picture here to put it in front of you. It's a 28-member team. This team is exclusively focused on our blue ocean maritime finance business. These are comprised of individuals who spend 100% of their time on what it is that we do, senior in their careers, having spent the majority of their careers working either for banks in the maritime units or directly for shipping companies. By design, we have a global presence here. We have an office and headquarters in New York, but then we also have our team in Amsterdam and Oslo. We have members in London and Paris in the Middle East, really focusing on our core markets on a strategic basis that we've built out over time. And then that's supported by our risk management and transaction execution team that oversees all of the numbers, all of the models, all of the financial statements, all of the cash flows to ensure that we have the integrity of our portfolio management, to ensure that we have no unintended risks in our portfolio, and that we're following the evolution of these underlying disparate shipping markets. And so when you talk about scale and experience, another differentiated factor that we think we personally have an advantage on in this market. And the scale point now comes through in a couple of these numbers, which I look at this as like a strategy metrics page, call it an overall report card of everything that our business has been able to accomplish. A few of the numbers that stand out to me here, we've now done 117 transactions, deploying $6.5 billion since we launched in 2017. So you have this long demonstrated track record of understanding the market, being able to complete time-sensitive and complex transaction that adds to that reputation in the marketplace of us being a go-to provider. Most of what we do is directly sourced. This is not situations where we're working with either private equity sponsors or club deals where there's multiple different creditors all fighting it out to figure out who's in charge. These are customized SPVs largely where we are senior in that capital structure. We provide a loan, no different than a bank providing a loan for a house mortgage. Here, we're providing the loan for the ship, and we get the keys to the ship. We get the first priority mortgage on these underlying vessels, as well as assignment of earnings and insurances that come to us that are a form of risk protection. Most of what we do is simple in that aspect. And then we also do everything in shipping, though. We show in the middle pie chart across our history, we've done many different of the shipping sectors. We just don't do them all at the same time because it's not appropriate to do all of them at the same time. Given where those cycles are in shipping, some are appealing, some are less appealing because the risks are elevated in our view. And that's something that we spend a great deal of time and we think bring a level of expertise to navigate and figure out which of these underlying shipping markets really make the most sense at a given time when you're talking about capital deployment. And then you put that all together, and then how it benefits to the return stream is not only on the upside, but it's the downside. Of the 62 deals that we have fully exited across our history, the single lowest performing individual transaction is a positive net 8.5% IRR. So when you really get down into assessing the benefits and merits of a strategy like this, it's not only looking at the absolute return number one, but it's the composition of the return track record, the consistency, and the downside protection that comes with that. This is a strategy that really presents a lot of cash flow and strong downside protection to go along with it. The overall returns that I mentioned at the upside, again, this kind of takes care of itself if you can control the downside, but we've been able to generate returns that are in the mid-teens. These are net, unlevered, IRR since inception, just over 16% is what we've been able to do. And when you read some of the things about the credit markets or alternative markets, some of the frustrations people have is that, oh, you come into a structure, it takes too long to put the money to work, or it takes too long to get your money back. This stands in stark contrast to those comments. This is a strategy where when we put together a new fresh fund, we expect to be fully invested in roughly 2 years. And then after that, you start to see cash flow and distributions come back such that we have a high level of cash generation coming back to you, the end investor. And we show that through the net DPI figure in our track record. Stands for distribution to paid in capital. Or basically, if I give you $100, how much have you already given me back? Most of the shows that are more mature funds have already given significant capital back to the investor. So another appealing aspect of a strategy like that. And then when you get down to it, right, it's not only that absolute number or the cash flow, but it's the downside protection and the uncorrelated nature that I think really resonate with a lot of trustees on the public pension fund side here. And what we show here is a chart that dates back to the inception of our track record and simply compare it to pick a bogey. We show here equity markets, we show infrastructure markets, we show bond markets, the high yield bond markets, not only over time, but importantly, highlighting what we call these periods of elevated uncertainty or market stress, where you saw sharp and material reductions in values across a lot of those markets, pullback in some of the drawdowns in some of those markets, whether it's the COVID period that we all lived through where equity markets were down 40, 50%, some of the inflationary concerns, or the Russia, Ukraine, Middle East conflict that we've heard about, and of course, more recently, with the trade war uncertainty, how some of those different market dynamics have impacted markets, whether it's traditional or alternative. What we show here is our track record in the orange bar, orange line with the black dots, how it's been differentiated, how it's been steady, how it's avoided the sharp drawdowns, how it's been consistent. And that speaks to the lack of correlation and strong downside protection inherent in a strategy like this, which again, I think things are very important to consider in uncertain times like this. Mentioned the cash flow point, so I won't necessarily belabor this, but this is a chart that shows not only the pace of capital deployment in the blue, but then the pace of capital return in the excuse me, in the orange, where again, on average, fresh capital coming in, we think given our elevated pipeline and opportunity set, we can fully deploy capital in about 2 years, which is consistent with our historical track record. And then shortly thereafter, what you see is this turns into cash coming back to you, the end investor, which we show through the orange bar charts, where it's smaller at first until we're fully invested. And then you start to see that orange bar chart meaningfully improve as the cash that comes back to us. Again, if we're getting 11 to 14% interest rates, plus a couple percentage points on fees, plus principal payback coming back to us, we're getting anywhere from 15 to 20% of our overall capital at risk returned back to us every year. Not only is that good for cash distribution, but it's an important part of the risk management and risk reduction strategy that you have here. And that's where I want to end my comments, is really on this downside risk. For us in this industry, we think a lot about downside risk. How can we get hurt? What are the risks out there? What do we know? What do we don't know? How do we get comfortable in the market? There's no such thing out there that we're aware of that is risk-free completely. Most things in investing have an element of risk. Can you take prudent risks out there in the market and earn attractive return profile? And we think the overall structure provides a framework here that we've been able to not only do in the past, but are confident we can replicate in the future. And that comes down to these 4 pillars. We're focused on hard asset lending strategy. The underlying assets that we're lending against are critical to global trade. They tend to be liquid. This is something I haven't mentioned yet. When you think about a position of a creditor, they're getting paid back based on the interest and the principal that they require. If there is an issue, they need to take control of the collateral and turn that into cash to make themselves whole. Well, one of the interesting things about shipping is that a lot of the assets we finance have underlying liquidity markets that are 3 to 4x more liquid than a lot of real estate markets globally. So many of the assets we finance can be traded in the secondary market, and the transactions historically have been in the 10 to 15% per year of annual asset turnover. That's a very liquid market. So we're able, if necessary, to take control of these underlying assets and simply sell them in the secondary market to turn our collateral into cash to make sure we have what we need, which is coverage of our loan. So if you focus on high quality assets where you know the shipyard that they're made, you know the year that they're made, you know the quality that it's made, you know the design that it's made, that it's understood globally to be a high quality asset, that's where we tend to focus. It tends to be what we call the equivalent of the Honda Accords, the Toyota Camrys of the world, the very high understanding vessels that are traded globally that are highly used. At the same time, from a structure position, again, senior in the capital structure, we're the only debt providers in most of our positions where we're directly working with the borrowers. We're in a position of control. The loan to values at inception tend to be, call it 50 to 75% with a high level of coverage there. And then on the cash flow, if you're getting that 15 to 20% of your capital at risk returned back every year, that is really one of the biggest defenses starting from the inception of your loan profile on the downside protection. So highly cash generative strategy is part of what we do. And then it's also, know who you're dealing with. In this industry, I mentioned it's big. It's 4,000 companies, $2 trillion assets, 133,000 vessels globally. Um, do you know who you're dealing with? Of these 4,000 companies, our universe, roughly, we estimate it to be about 300. So we don't deal with all of them. It's a selective group on purpose. We're making sure we deal with only those who have a long operating history of understanding these markets, working through the cycles, have the financial wherewithal to add and contribute equity to the structures where necessary, and have a long history of experience working in these shipping markets that we can point to. And those things we think are all very important. Number here that I also wanted to highlight is at the bottom. So for us as a creditor, and if you work or speak with any credit manager that's out there, ultimately they're going to encounter a situation that was unexpected. You're going to have what's called a negative credit development, which is essentially a default on your loan. And so how do you work through a situation like that? Well, one of the things that we think is important about this shipping market is that we would argue while there is still potential for a negative credit development or a bankruptcy or a restructuring that's going to be required here, we think the probability of actually incurring a loss is lower compared to other strategies. And so for us, we have some data to support that. We've done 104 what we call primary issued loans. Of those, four of those, we've had to go through an element of restructuring. In all four cases, one is complete, the other three are moving forward and progressing. The completed one was a positive investment outcome. The other three that are nearing their completion are all a trajectory towards a positive investment outcome. Back to the downside protection. If you have the asset, if you have the structure with the cash flow and a known counterparty, that is your baseline for protection. And it's something that we think is an important part of what it is that we do. Let me pause my comments there for now. Happy to take questions on that. As you can see, we're pretty excited about what it is that we're doing in this maritime industry. Again, it's a big industry. It's absolutely critical to the global economy. There's limited to no replacement risk going on with these assets, regardless of the technology that's coming out of Silicon Valley that could impact other industries. Here, shipping, we think, is somewhat immune to those situations, but it needs a lot of money. There isn't a lot of money that's able to do what we're allowed to do. Competition isn't as extreme here as it is in other areas of the market. And when you have that position that we have in the market, you're able to structure really interesting transactions that can deliver on the return potential while also having proper protections in place to help on that downside. And that we think is that formula to create the track record that we have, where hopefully we're poised to continue to execute on that.
This is all based on a capital call model. So there's no evergreen function. So you would a county, a city decides to go in on this. You're doing a capital call sometime in this year and a half time frame. Correct?
Yeah, that's correct. We've structured it as a closed-end vehicle. So closed-end vehicle is one where it's a commitment drawdown structure. Our investment period is 4 years. And so over that period of 4 years, we will, as we find investment opportunities, gradually call down a portion of your commitment to make those investments. We do have the ability to recycle capital. So after what we think is about 2 years to get fully invested, we do have the ability to recycle into new transactions if they come about. But then after that 4 year period, what happens is it turns into what's called the harvest mode or the realization mode, such that any cash flow that comes back ultimately is fully returned to you. And then this vehicle is wound down. Roughly, if you think of it from start to 4 years as the investment period, probably another 5 years or so. But during that time, most of your capital is already returned to you, the end investor.
And then, I mean, and understanding this is obviously the type of investment that you're making a commitment to. If an entity though found themselves with cash flow issues and they needed to extricate themselves. Are there opportunities for anything that would enable if County needed to get more liquid?
Yeah, there's no contractual opportunity for folks to accelerate redemptions or liquidity in a structure like this, which frankly, if you read about the headlines that are going on right now with some of our peers in the private credit space dealing with redemption gating, that's sort of the issue is when you have these open-ended structures, it doesn't necessarily align with the liquidity of the underlying investment. So we choose to keep it at this closed-end structure, which fully matches. That being said, based on a historic profile and our expectations of the cash flow profile, there is meaningful cash generation that happens throughout the loan and the tenor that comes through with this structure.
So from a practical standpoint, we're talking about a 4 year window. That you would say, look, we're making a 4 year commitment.
Yeah, so the commitment for us to invest money is 4 years, and then if there are investments which we expect there to be at the end of those 4 years, then they will remain in the portfolio until they're fully liquidated, which could be another 4 to 5 years.
Okay.
Yeah, but by that point, a lot of the cash would have already been returned to the end investor based on our historical profile.
So the commitment is really around 9 to 10 years. Yes, with the hope that the last 4 or 5 years, you'll be getting your distribution, returning your capital, and some, of course, the gains you've received.
Yeah, that's a proper way to think about it. This will probably be a line item on your overall performance report for your overall plan for upwards of 9, maybe 10 years, something like that. But most of the capital and return would already have been baked in by that point, and that's kind of what we try to show on this is that over a period of 2 years, we think it takes to get fully invested, and then we're recycling some money. But then you can see right around this period here, which is about 3 to 3.5 years in, you start to see this growth in the orange bar charts, and that's when the distributions really kick in. So here at the end, they still have, for this particular fund, still have some remaining value, which is a small part of the overall value that's been created. So the overall value that's been created is well in excess of what has been called. And most of this has been returned, but there's still a tiny amount that remains invested. That is the result of, in this case, one transaction that we're finalizing.
And then this is all in dollar denominated, where you're not having to currency trade in order to access the investment.
Yeah, so for the end investor, the fund is a dollar denominated vehicle. For us, the overwhelming majority of the transactions we execute are dollar denominated. It's an industry that tends to be focused on the US dollar for the transactions. There have been a couple of situations that were non-dollar denominated transactions, and then we do some of the hedging on our own with some of the banks. Wouldn't be anything you, as the end investor, would have to consider. All the fund cash flows and reporting is in US dollar.
And then just as far as reporting, because we're dealing with international, is there any like extra levels of reporting or compliance that the investor has to be mindful of?
No, nothing that we've encountered that's different than other funds that are out there.
Okay. Any other questions? Anyone else? Don't see any. All right. Well, I think we have a couple of minutes. If you have any final remarks or anything.
Yeah, nothing from us. Appreciate the audience today. Appreciate the opportunity. I would say, we're traveling the globe. For us, we're in active capital raising mode. For us, when you look back over the last couple of years, we've invested more money than we've raised. And so we're at a point where we're trying to catch up to make sure we have the capital on hand on our balance sheet to meet the demands of our underlying borrowers. The number of people we deal with, the geographies we deal with continue to expand. It's an area where we're growing methodically, but this is still for us, A record year was 2024, where we deployed 1.5 billion. 2025 was just under that at 1.4. So while we think we're among the largest alternative lenders in this space, it's still small compared to the 80 to 90 billion dollars a year needed for this industry. So there's still a long, what we believe, runway for growth. And we're excited about the pipeline, excited about the opportunity set and the transactions that we're seeing. And kind of in a weird way, to the extent there are more challenges from a global headline perspective, that tends to lead to more opportunities for us. So that causes a further retrenchment, more uncertainty, a further retrenchment in some of the other players who are out there, which allows us to execute on our time proposition where we can act quickly and with certainty in terms of some of the variables that we're assessing.
Actually, and one final thing for those of us who might have ESG concerns, particularly as it relates to like climate impact, things like that. How does this work in regards to that? I know on one hand it's very efficient; it's the most efficient way of moving, but it is, I guess, a carbon intensive industry. So how does that play out?
Yeah, it's a fascinating discussion on that point. When you think about the industry and its massive impact on the global scale, it is, as I mentioned, the most fuel efficient and cost efficient way of moving mass quantities of good. But because of its size, it's also the single largest pollutant to the global environment. So for us as a lender, one of the things that we assess is the fuel efficiency of these vehicles. It's in our best interest to focus on assets that have a high resale value, that retain their value. And so what you tend to find is that these assets out there have about 25-year useful lives. Where we tend to focus is in that middle life, which is about 10 to 12 years of their overall life cycle. And we're focusing on assets that have better fuel efficiency, more modern upkeep of a lot of their systems and engines that are out there compared to the, I would say, older vessels that are on the water. So while it's not an ESG focused fund, it is certainly in our best interest and part of our analysis looking at the environmental impact and qualifications they have on that aspect with the vessels that we are financing. With that being said, part of the huge opportunity set going forward, a big portion of the global fleet is aging. There is going to be billions of dollars that is going to be needed in order to refurbish that. And a lot of that is going to be due to aging equipment that is aging out and less fuel efficient, where you're going to need to come in. And so the technology aspect, even if there are improvements in propulsion and fuel efficiency, the main value of these vessels really is the actual ship. So even if the technology changes happen, it's still the ship itself. The body of the ship is the main part of the expense here, and that's not going to change anytime soon.
No, I'm muted. All right, I don't see anyone else, and so with that, I think we're right on time. So Bryan, would like to thank you for this update and all, and then I'll be able to send out this deck to everybody that signed up today.
Sure. Well, thank you again for the opportunity to get in front of you all. Appreciate the audience and the questions. Have a great day.
Thank
Thank
you.
you.
Have a great day.